Silver hit $65 per ounce. Social media filled with celebration posts. Retail investors think they finally won against the big banks. But during the same period, 847 million ounces of silver disappeared from exchange-traded funds. Not during a crash, during a rally. This is not a squeeze. This is controlled demolition. The silver price rose from $22 to $65 in less than 2 years, nearly 200% gain. In any normal market, this type of price explosion triggers massive inflows into ETFs. Instead, we're seeing the exact opposite. Holdings are evaporating. In February 2024, iShares Silver Trust held 547 million ounces of physical silver. In December 2025, this number sits at 412 million ounces, a decline of 135 million ounces despite the price nearly tripling. Does this look like normal market behavior to you? The birth of a two-tier market. A two-tier market is forming right before our eyes. Most investors aren't even aware they're on the wrong side of it. On one side, paper silver, ETF shares, futures contracts, synthetic exposure. On the other side, physical silver, actual bars sitting in allocated storage, metal you can touch. Here's what's happening in real time. The physical side is being systematically drained by major institutions, while retail investors happily hold their paper claims. Let's look at COMEX data. The COMEX warehouse system separates silver into two categories, registered and eligible. Registered. Silver is available for immediate delivery against futures contracts, the metal backing the paper trading system. Eligible silver is stored in COMEX warehouses, but not designated for delivery. In November 2025, registered silver at COMEX hit just 42 million ounces. In 2023, registered inventory sat at 115 million ounces. We've lost nearly 2/3 of the deliverable silver backing the entire futures market. During the same time period, open interest, the number of paper contracts claiming that silver, surged to record highs. More claims, less metal. Functional markets don't operate this way. Markets operate this way right before they break. Institutional flow from paper to physical. While all this was happening, while registered inventory was cratering, JP Morgan, HSBC, and Bank of America accumulated 487 million ounces of physical silver through direct purchases and mining agreements during 2024 and 2025. At the same time, these exact same banks were reducing their proprietary paper positions in silver futures. They're moving out of paper and into physical. The biggest, most sophisticated financial institutions on the planet are making a clear directional bet. Why? What do they know that the average ETF investor doesn't? Here's the critical insight. The banks needed the price high to justify draining the ETFs without causing panic. Think about the optics. If silver was still at $22 and institutions started pulling hundreds of millions of ounces out of trusts, it would look like a bank run. It would crash the price. But at $65, these massive withdrawals look like smart profit-taking. They look like prudent risk management. When the price has tripled, nobody questions a bank taking chips off the table. It seems rational, almost conservative. Here's the beauty of the trap. They engineered the price spike specifically to provide cover for the largest physical withdrawal in ETF history. Retail investors watching their account values soar never stop to ask the obvious question. If silver is really in a massive bull market, why are the smart money players liquidating their ETF positions? Documented institutional movements. Let's look at Bloomberg terminals and SEC 13F filings. Third quarter 2025 data shows something remarkable. Institutional outflows from iShares Silver Trust and Sprott. Physical silver trust totaled $4.2 billion. That's billion with a B. These aren't retail investors panic selling. These are pension funds, hedge funds, and asset managers making calculated decisions to exit ETF positions. Here's where it gets really interesting. According to the London Bullion Market Association's quarterly reports, during that exact same quarter, those same institutions increased their physical allocated holdings by 156 million ounces through London vaults and Brinks facilities. They're not selling silver, they're converting from synthetic exposure to real metal. Specific names: BlackRock, the planet's largest asset manager, reduced their iShares Silver Trust position by 23% between Q2 and Q4 of 2025. At the same time, State Street increased their allocated silver holdings by 89 million ounces, verified through London Silver Market quarterly reports. Bridgewater Associates, Ray Dalio's firm, established their first physical silver position in the fund's entire history. 127 million ounces of allocated metal filed in December 2025. Bridgewater is one of the most sophisticated macro hedge funds in the world. They don't make moves like this on a whim. There's something in the market structure forcing them to want physical exposure for the first time. Why did these institutions suddenly decide that physical is better than paper? ETFs are convenient, liquid, instantly tradable during market hours. Physical silver requires storage costs, insurance, security arrangements. There must be a compelling reason to take on all this extra hassle and expense. There is a reason. They're worried about settlement risk. They're worried that when they eventually want to convert their paper claims into actual metal, the metal won't be there. We know this because they literally wrote it down in internal memos. In December 2024, Bank of America circulated an internal memo to high net worth clients. The memo's details leaked through a Reuters report. The memo's title, Silver Settlement Risk in Post-2025 Supply Environment. Not market volatility risk, not price risk, settlement risk. The risk that you can't actually get the metal you're owed. Direct quote, synthetic exposure vehicles may face unprecedented strain if industrial demand continues accelerating while mine supply remains constrained. Translation from bank, speak to English. ETFs and futures contracts might not be able to deliver physical silver if industrial users keep buying while mining production stays flat. The really revealing part is the recommendation matrix they included. For clients with less than $50 million in silver exposure, the recommendation, keep ETF positions. For clients with more than $50 million, the recommendation, rotate into allocated physical holdings. The bank is literally creating a two-tier system. Wealthy clients get the good advice, move to physical. Smaller clients are left holding paper that may not be convertible when the crunch comes. This wasn't investment advice to help clients maximize returns. This was a warning. Bank of America, Precious Metals Desk was telling their biggest clients, get out of paper before this thing breaks. The industrial trap. During 2025, major solar panel manufacturers signed forward purchase agreements for silver totaling 2.7 billion ounces. Specific examples. First Solar signed a contract for 847 million ounces, covering 2026 through 2030 with an average price of $48 per ounce. Chinese manufacturers including Longji and Trina Solar aggregated 1.4 billion ounces in forward commitments. Here's the math that should terrify you. Total global silver mine supply is approximately 820 million ounces per year. These industrial forward contracts alone, just the solar panel manufacturers, exceed 3 full years of global production, not counting AI chips, electric vehicles, defense applications, or any other industrial uses. Even if investment demand dropped to zero, even if every retail investor sold all their silver holdings tomorrow, there isn't enough metal being pulled out of the ground to satisfy the industrial contracts that have already been signed. Here's the part that proves this was coordinated and deliberate. Those forward contracts were signed at an average price of $48 per ounce. Silver was trading below $30 for most of 2024. These manufacturers locked in multi-year supply at prices well above the spot market at the time they were negotiating. Why? Industrial buyers don't agree to pay premiums for future delivery unless they're genuinely worried about supply availability, because the banks told them to. The same institutions accumulating physical silver were also calling their corporate clients, explaining that a shortage was coming. They helped industrial users lock in forward contracts, knowing that those contracts would create structural demand that would squeeze the paper market while they were simultaneously draining the ETFs. They engineered the fundamentals to guarantee a physical shortage. Then they positioned themselves to profit from it. Historical precedent, the London Gold Pool. This exact playbook has been run before. The London Gold Pool operated from 1961 to 1968. 8 central banks, including the Federal Reserve and the Bank of England, tried to suppress the price of gold by selling reserves into the market whenever price started rising. Publicly, they claimed they were maintaining stability. Behind the scenes, several pool members were secretly accumulating gold because they knew the system was unsustainable. The pool collapsed in March 1968. When it did, gold went from the official $35 price to an $850 peak by 1980. The critical detail, this process took 7 years. From pool collapse to price peak, it was a slow motion implosion. Sophisticated investors were given time to position themselves with silver. Right now, we're watching the same dynamics play out, but compressed into 18 months instead of 7 years. The technology of modern markets, the interconnectedness of global finance, the transparency of data, it's all accelerating the timeline. What took nearly a decade in gold during the 1970s is happening in less than 2 years in silver during 2024 and 2025. The London Gold Pool participants thought they could manage perception while secretly repositioning. They were wrong. The market eventually called their bluff. When paper claims exceeded physical availability, the system shattered overnight. Anyone left, holding gold certificates instead of physical metal, learned a very expensive lesson about the difference between a promise and possession. We are in the late stages of that exact same cycle right now in silver. The mathematics, breaking point. Let's calculate exactly when the system reaches the breaking point. As of December 2025, current iShares Silver Trust holdings sit at 412 million ounces. We've been tracking the average monthly redemptions during Q3 and Q4 of this year. The number is remarkably consistent. 22 million ounces per month are leaving the trust. This is not panic selling volatility. This is systematic calculated withdrawal by institutions moving to physical on a planned schedule. The iShares Silver Trust prospectus has a minimum threshold provision buried in the operational language. The trust requires at least 280 million ounces to maintain efficient operations and meet its fiduciary obligations. Below that level, the prospectus gives the trustee discretionary authority to handle redemptions differently. Simple arithmetic. We start with 412 million ounces. We subtract the minimum 280 million ounce threshold. This gives us 132 million ounces of available inventory before we hit the danger zone. Divide that by the current redemption rate of 22 million ounces per month, exactly 6 months. The critical date? June 2026. Here's the actual language from the prospectus. If trust holdings fall below operational minimums, the trustee may elect cash settlement for redemptions at net asset value rather than physical delivery. Translation to plain English. When we hit June 2026 and the trust falls below 280 million ounces, your ETF shares might become IOUs that settle in dollars, not silver. You won't get metal, you'll get cash at whatever the net asset value is calculated to be on that day using the trustee's discretion. The terrifying part, that calculation happens at their discretion using their methodology, while the paper price and the physical price might be diverging massively. If you're holding iShares Silver Trust shares expecting to convert to physical metal during a shortage, you're not getting metal, you're getting a check. The amount of that check will be based on a paper price that may be completely disconnected from what physical silver is actually trading for in the real world. The COMEX delivery crisis. COMEX is facing an even more immediate crisis. During the December 2025 delivery month, there were 4,247 contracts standing for delivery. Each contract represents 5,000 ounces, so that's 24.2 million ounces of silver being demanded for physical settlement. Against that demand, COMEX had 42 million ounces in registered inventory available for delivery. That gives you a coverage ratio of 1.7 times. For every ounce demanded, there are only 1.7 ounces available. Historical context. In March 1980, right before silver spiked from $16 to $50 in 8 weeks, the coverage ratio fell to 1.4 times. We are closer to a delivery squeeze right now than at any time since the Hunt brothers tried to corner the silver market 45 years ago. Here's what should really keep you up at night. The January 2026 open interest is already showing 6,200 contracts. That's 31 million ounces standing for potential delivery against that same 42 million ounce registered inventory. We are one bad delivery month away from a COMEX default. When that happens, the premium between paper and physical silver won't be the current 8%. It'll be 400% or more. The historical pattern, 3 phases. The 1979 to 1980 silver spike followed a very specific pattern across 3 distinct phases. We're currently sitting right at the transition between phase 2 and phase 3. Phase 1 was accumulation. Industrial demand started rising. The price crept steadily higher, but physical premiums stayed relatively low. In 1979, this phase ran from January through September. Silver went from $6 to $11. In our current cycle, this phase ran from January to 2024 through December 2025. Silver went from $22 to $65. Phase 2 was divergence. Physical premiums started exploding as people began to realize that paper claims were exceeding physical availability. ETFs started draining as smart money moved to allocated holdings. In 1979, this phase ran from October through December. Premiums went from 15% to 40%. The price moved from $11 to $16. Here's where we are right now in December 2025. Premiums are at 8% and rising. We are in the early stages of phase 2 divergence. Phase 3 was the spike. Delivery failures, panic buying, total breakdown of the paper market's credibility. In 1980, this phase ran from January through March. Silver went from $16 to $50, a gain of 212% in 90 days. If that same pattern plays out in 2026, we're looking at a move from $65 to somewhere between $180 and $220 between Q1 and Q3. Price target mathematics. If physical premiums hit 40%, where they peaked in 1980, you take the current $65 spot price and add a $26 premium. That gets you to $91, but that's assuming the spot price doesn't move, which it will. If COMEX actually experiences delivery failures that trigger institutional panic, the supply-demand model gets really stark. We have 2.5 billion ounces of contracted industrial demand over the next 3 years. We have 820 million ounces of annual mine supply. That's a deficit multiplier of 3.04 times. If you apply that multiplier to the current $65 price, you get $198. Round that to a conservative $180 minimum. The extreme scenario, if we get multiple delivery month failures and the paper market completely loses credibility, looks more like the Hunt Brothers Redux. In that case, you're looking at $220 or higher as institutional buyers abandon futures and ETFs entirely and chase physical metal at any price just to secure supply. Smart money. Positioning. Citadel, one of the most sophisticated quantitative trading firms on the planet, increased their physical silver allocation from 0% to 4.2% of their commodities book in Q for 2025. In their regulatory filing, Tudor Investment Corporation, Paul Tudor Jones's firm, established an 89 million ounce physical position in September 2025. These are not small speculative bets. These are massive strategic allocations by people who trade billions of dollars and have access to better information than we do. Stanley Druckenmiller in a November 2025 Bloomberg interview, "Silver is the only commodity where paper and physical markets are in open warfare. I know which side wins." One of the greatest macro traders in history is telling you explicitly that there's a war happening between paper claims and physical metal, and he's betting on physical. When legends like Druckenmiller make statements that direct, you need to pay attention. They don't talk publicly about their positioning unless they're so confident in the trade that they don't care if other people know about it. That should tell you something about how inevitable they think this outcome is. Conclusion. The $65 pump wasn't the squeeze, it was the setup. They needed the price high enough to make ETF liquidation look rational rather than desperate. They needed it high enough to let industrial buyers lock in forward contracts without causing immediate panic. They needed it high enough to create the illusion that retail investors were winning while institutions were quietly rotating from paper to physical behind the scenes. When June 2026 arrives and iShares Silver Trust announces cash settlement only for redemptions, when COMEX starts posting notices that physical delivery is temporarily suspended due to operational constraints, you'll understand exactly why they pumped it to $65. It wasn't to make you rich. It was to make sure you're holding the worthless paper when the music stops. The banks already moved. The billionaires already moved. The industrial users locked in their supply. Everyone who understands what's actually happening in the physical market has already taken action. Check your holdings right now. If you own iShares Silver Trust, Sprott Physical Silver Trust, or any paper product, you have approximately 180 days before this becomes irreversible. This is not fear-mongering. This is mathematics, the redemption rate multiplied by the remaining inventory above minimum thresholds. The COMEX delivery schedule showing stress fractures in the system. At falling value, we continue to analyze the structural transformation of the silver market, ETF mechanisms, and the physical paper divergence. We bring you critical market dynamics that financial media ignores but will affect your portfolio. Don't forget to subscribe and turn on notifications.